Just gonna present this one. Ooh. Alrighty. Can I get a thumbs up from someone? Great, thank you, Amir. You can see my screen there, perfect. Alrighty, let's get going. So what are we going to go through tonight? As I said, bit of a catch-all. We're going to have a look at the history of property in Australia, some of the trends we saw from the prices in 2023, and some interesting trends in 2024 and beyond as well. Having a quick look at why we like buying property, particularly here in Australia, some challenges that the next generation have when it comes to property, and then we'll focus more on the actual how-to. So how you go about buying a property, what are some schemes that are available, and why would you work with a mortgage broker, which is what my business does. So starting off with a history of property in Australia. Now, this, when you take it over the long term, looks like it goes up and up and up. We know that property, as any asset class does, has its ups and downs. And you can see that on the graph. We won't go into the details of all the tiny text there, but as you can see, the market goes in cycles. You can see lots of ups and downs there. But I guess what we can see is that house prices in Australia have risen significantly over the past 30 years. So you can see they're averaging out just under the $1 million mark nationally at the moment. Lots of different things that have happened to impact that. We've had the COVID pandemic recently. We had a really big pullback in migration, but also, as I'll go through in a moment, we've seen, a really big growth in overseas migration as COVID's kind of come down. The borders have opened up, and we've really seen that start to take off as well. In terms of 2023, this is a really interesting table from CoreLogic, who are one of the big kind of data providers in the property space. Look, overall, Australia did very well in property in 2023, and I think this came as a surprise to quite a few experts in the industry. We saw a lot of rising interest rates in 2023, which I think some people thought might lead to a bit of a pullback in prices, but in fact, pretty much all of the capital cities saw growth in 2023. Going down, we've got the top city was actually Perth for 2023 at 20.7%. Followed by Brisbane at 17.9%. Now, interestingly, as we'll go through, these two cities are the cities where we're actually seeing a lot of interstate migration. There's overseas migration, absolutely, although the bulk of that does normally go to New South Wales and Victoria. But Brisbane and Perth seeing a lot of interstate migration from those other capitals as well. They are traditionally more affordable. So even though you can see high growth rates there, they're going off, I guess, a lower base. So a lower median value you can see on the right there compared to the likes of particularly Sydney and Melbourne as well. Interestingly, the other capitals are quite fast, kind of getting close to Melbourne. You can see Brisbane actually slightly outstripping Melbourne there, and Sydney being the clear outlier in terms of being quite expensive. The only capitals to see a decrease in 2023 were actually Hobart and Darwin. Overall, though, a positive year for Australia all round. Capitals did see a higher increase than regional areas. This one's quite an interesting one coming off the back of COVID. During COVID, we saw a lot of people moving out of the cities into regional areas, and that, I guess, growth rate hasn't continued to the same degree. And we are seeing, some degree of people moving back to the cities as well for work. So, as I said, when we look at migration in Australia generally, we're on the move, lots of people moving around all the time. We've got on the left there, people moving into Australia. And I guess why I'm talking about this is because when we think about property more generally, it's where people live. So where people are moving really does make an impact, I guess, on the market as a whole. So international migration, Australia welcomed 737 international migrants in financial year 2023. So that's July 2022 to June 2023, which was a net gain. So if you take away the people that left, of around 518,000 people. So this was a 73% increase on the year before. So definitely seeing international migration come back in full force. And most of these arrivals settled in New South Wales, Victoria, and Queensland. Then we look at interstate migration. So as I said, we are seeing a lot of interstate migration, particularly to Queensland and to Perth from New South Wales and Victoria. As these cities get bigger, of course, there's more job opportunities available, and these areas are more affordable than Sydney, for example, particularly for people who might want to start a family and want to afford an actual house rather than just an apartment. I'm saying this as someone who lives in Sydney myself, and has a nice 1-bedroom apartment at the moment. So yeah, definitely some more affordable spots other than Sydney out there. And the third one on the right there is urban sprawl. Now, this is quite an interesting one. The government's talking a lot about this when it comes to housing affordability. The first point of this being rezoning certain areas. So depending on the area, there may be certain restrictions that the government and councils place on what type of properties can be developed or built there. So, for example, you can't build high-rise apartments in a lot of areas. And you might only be able to build duplexes, for example. Now, what the government's looking at is, due to property becoming more unaffordable, particularly in cities, they're looking at rezoning some of those areas. So, for example, an area near a train station that traditionally could only have a townhouse on it may now be able to have an apartment block on it, for example. So that's something that's come up in the media quite a bit recently. And then people that do want those larger properties, they want land, they're having to buy further out, essentially, rather than, buying closer into the city like they maybe could have done 20 years ago. Again, I think I've pretty much covered this, so I'll skip through it and get to the more juicy stuff about how to buy a property. But this graph is quite interesting and just shows the growth rate. If we look from left to right, the blue graphs are showing the net overseas migration. The red bar on the graph is showing net interstate migration. And then on the right, you've got natural increase. So that's essentially births that have happened. So you can see it really varies quite a lot around Australia. Queensland and Western Australia, they're the only ones that are seeing growth pretty much in all areas. New South Wales, the ACT, Tassie, Victoria, and South Australia all seeing, so across the board, a lot of overseas migration, but then natural increase as well. Varies a little bit, but overall it is going up too. I guess as we've got an aging population, people living longer too, that net natural increase is in the positive at the moment in Australia. Alrighty, so why do people want to buy property? I guess these are 3 areas that I'll look at specifically, but when it comes to it, I think probably all of us or most of us would have had an idea from a pretty young age that one day we buy a property. And it's kind of synonymous, particularly with, the Australian dream, as they call it, or kind of this symbol of success maybe that some people have. And so these are 3 areas that I guess people look at in terms of, this is why I want to buy property. Again, it's not exhaustive. It just is an idea of, why property might be attractive to people. So the first one I've got there is tangibility. And this is, I guess, comparing property to an asset class like shares. Many people feel more comfortable investing in something they can touch and see. It's a real asset, right? So even if you're someone that thinks you don't understand finance, which is a whole other conversation, property, I guess everyone gets it because we live in it. And so it's something that anyone can understand. Because of this, property is also an emotional investment. And I guess a lot of people would see it not necessarily as a status symbol, some people definitely do, but as a symbol of some level of comfortability or financial stability. And so it's something that everyone is quite interested in. And an example I thought of was at an auction, right? Why do we have auctions? And it's because people have emotions, and essentially it is in the auctioneer and the vendor's best interest to get the best price for the vendor. And how do they do that? By creating a sense of urgency and a sense of competition, essentially, between buyers. The second point here is leverage. Now, leverage is a whole topic in itself, but at the basic level, I guess, leverage is essentially using borrowed funds to invest, and then the returns on those funds you essentially are the owner of. So when you buy a property, let's say you've got a property value of $500,000 and you put in a 20% deposit of $100,000. If that property goes up 10%, so from 500,000, you've made an extra $50,000 on, I guess, invested funds of $100,000. Now, I'll caveat this with, there are a lot of costs to property. that are different to investing in shares, for example, where depending on what you invest in, there aren't many costs involved. Whereas a property, you've got maintenance, you've got interest on a loan, and a whole bunch of other costs. So you do need to take the whole cost into account. But if we compare 10% on a $500,000 property being $50,000 gain, with $100 invested, compared to shares, for example, if you invested $100,000 with no leverage, made a 10% gain, you would make $10,000 in gain. So again, that is a very oversimplified explanation, but gives you an idea, I guess, of property as an asset class and its kind of unique properties there. The third factor on the right is viability. So property, I guess, has always been an attractive asset class because everyone needs somewhere to live. So kind of tied to the first one, but a lot of people think about it, well, you know, if I don't own a property, I'm going to pay rent. So it's kind of this inevitability almost for a lot of people of, oh, well, I might as well buy and I want to get into the market. And the last point there is there are certain government schemes and potential tax incentives that the government provides to property owners. What we won't be doing on any of these sessions, unfortunately, is going through tax. If you do want to know about tax, you need to go and speak to an accountant, unfortunately, or maybe I'll get an accountant to come on and they can speak about it on a session. That's a better idea. But yeah, tax can get a little bit tricky, but there are certain incentives. The ATO website is one of my favorite websites to visit. It gives you a lot of information on all things property tax, and it's pretty simple to understand. Okay, so what are some of the challenges for young Australians in general? It's not just for the young, but what is the challenge at the moment? Now, the first thing is property prices, clearly. Interesting stat here, the average Australian in 1984 could buy a home that costs 3.3 times the average annual income. Now, in 2023, this is 10 times. And if you're looking in an area like Sydney, I think it's more up around the 14 times the annual earnings at the moment, which is just crazy. If we think that's 10 times earnings, obviously not every dollar you earn is going into savings for property. So it is, yeah, definitely much, much harder than it ever was to buy property, especially if you don't have, you know, inheritance passed down or anything like that, which a lot of people don't. The second challenge we've got is servicing challenges. Servicing essentially means your ability to pay off the loan. So with interest rates rising, this means that essentially the level of income that is needed, because not only are property prices higher, when property prices are higher, it means you need to borrow a higher amount of money in order to have that loan. And it means you need to pay off for a higher amount per month because your average mortgage is still 30 years. So you're still paying off the loan in the same amount of time. It's just a much bigger loan. So a much larger income is required in order to service that loan. And kind of, again, linked to the point above, property prices have far outpaced the growth in income in Australia over the past 30 years, which has just led to that massive gap that we now have. Not to say, though, that there still aren't opportunities. There definitely is. And that's why we're going to go through kind of the process and different schemes available to help people get into the market. But it is good to know that it is hard and it's okay. But there are people out there that can help you. And the third one, lack of knowledge and access. Now, this one is something I found as kind of a more digital native, some might say, getting into the market. It can be quite hard to understand. There are still a few processes that seem quite archaic, I might say, in the property and loans industry, and it can be quite hard. There's lots of information out there, but what information do you trust? And who's going to help you every step of the way as well. So knowing which sources of information to actually trust and who to go to is, I think, a challenge for a lot of people when they go, I just don't know where to start. And I'm not ready to talk to a bank yet, but I just don't know where to go. So hopefully we'll answer that question for you tonight as well. Alrighty, so this is a question I get asked a lot, especially, you know, by people that have never gone through the property purchase journey before. Once you've gone through it once, you kind of go, oh yeah, it's pretty simple. But if you've never done it before, it just feels like a completely different world. I'm sorry if you can hear rain behind me as well. Sydney is pouring down at the moment, so hopefully it's not making the audio too bad. So the property purchase journey involves a couple of steps. I've got on the first point here, speak to a broker. Now, you don't have to use broker. Want to definitely caveat that if you are looking to get a home loan, you can definitely just go directly to a bank. However, I'll go through at the end just some of the reasons why you may want to speak to a broker. One of those reasons, particularly I find a lot of people I speak to, is they may not be ready to buy just yet. They may have a goal to buy property, but maybe they're 1 to 2 to 3 years to 5 years out from actually being able to achieve that goal, or they just have no idea when or if they'll even be able to. So they might come to me, perfect example of a friend I had the other day, coming and saying, I've got X dollars saved in the bank, but they have no idea about anything else. Can I buy a property? I've got, a certain amount set aside for a deposit, which is amazing. But yeah, no idea about what that actually means in terms of how much they could borrow, what areas they're looking at, that kind of thing. So you can always speak to a broker before you're ready to buy, because they'll be able to help you out just on a few of those things and actually get you to a point where you go, I know the steps I need to take in order to get to that point where I can achieve that goal. So having a conversation is always a good first step. And I just say, yeah, don't wait until you think necessarily that you're ready, because there may be government schemes, other things that can help you get in earlier than you think you might be able to. Or the other way, there may be debts that you have that might limit your borrowing capacity. There may be income restrictions, things like that. It is more complex from a financial and kind of data perspective than you might think it is, but the process is also simpler than you think it is if you just speak to someone that knows. The second step there is just to set your goals. So having a goal to actually work towards rather than just going, I have no idea if I'll ever be able to buy, is always a good one, just to actually help you save towards that or do whatever else you need to do in order to achieve that goal. Then we get to step 3, which is essentially, I'm ready. I think I've got, all the right funds, all the right situation ready to go. And I'm actually ready now to start looking for a property. And at this point, we do something called pre-approval. Essentially, you fill in a bunch of information, provide a lot of evidence around your financial situation, and that essentially goes to the lender of your choice, which is part of essentially what a broker will take you through, or direct bank. They'll take you through a bunch of questions about your current situation and your goals. That will then get submitted to a lender of your choice. That will essentially give you, it's not 100% finally approved, you're borrowing that much money, but it gives you an indication of, based on your current situation, that lender is likely to allow you to borrow that amount of money. So for example, if you had a goal to buy a property worth, I'm only using $1 million because it's nice and round. You had a goal to buy a property worth $1 million. You had your 20% deposit ready, so your $200,000. You had enough for stamp duty or your using schemes. You essentially would go and apply that to a bank based on your situation. They would say, yep, I'm happy to offer Megan, I'll use you to offer Megan a loan of $800,000 based on her situation to go out and make an offer on a property. And why you get pre-approval is you don't want to go out and make an offer and have a contract signed and pay a deposit on a property without having a pretty solid indication that the bank's going to lend you that amount of money. So that's why we do it. A lot of real estate agents will actually ask you if you have pre-approval before kind of making an offer on a property. So if you go to an inspection, it's often a question that they'll ask, are you pre-approved in order to purchase? Then once you've got your pre-approval, you've actually got 3 months in order to have an offer accepted on the property for that pre-approval to be live. And why it expires after 3 months is the lender knows that your situation might change in those 3 months or after 3 months. So they use that as a time period. You can reapply for that pre-approval if you like, but you will need to resubmit a lot of your documents just to show the lender that you're still, I guess, financially able to afford that purchase. So got 3 months to get an offer accepted on a property. And then let's say you've had an offer accepted. Then you will sign your contract, and often on the same day that you're signing your contract, you will pay a deposit. This can vary depending on the contract terms. It can be anywhere from, I guess, like 5 to 15%. 10% is pretty standard in the market. So you've got to make sure, and again, this is a bank will tell you, but a broker will also help you through this process and make sure a couple of weeks before you sign your contract, or essentially once you have pre-approval, that you actually have that 10% available and ready to actually pay when that offer is accepted. so you don't get caught out there with bank limits and the rest of things. And then after that point, you've got 4 to 6 weeks until settlement day, which is essentially when all of the loan funds all exchange and you've got the loan set up, it starts, the rest of the deposit goes to the vendor, and you essentially can move in. So during that time, there'll be a few loan documents that you sign, you get submitted for, I guess, a final loan approval as well. And then settlement day, normally as a client, you're not too involved on settlement day. Who's normally involved is the lender, often a solicitor who's the person that will help you with the contracts, the broker, if there is a broker, and I think I already said the lender, but yeah, the vendor's solicitor and your solicitor as well as the lender that is giving you the loan on that property. And essentially that all happens and the vendor gets paid their money for that sale. So I spoke about a lot of terms in that little process journey, but just some key things to know in terms of what actually affects your ability to purchase. So I've got 3 key areas here, and when you do go through the process of getting pre-approved for a loan, these are kind of the 3 big areas that will be tackled in terms of asking you a lot of questions and getting you to provide evidence as well. So the first one is your income and expenses. So there'll be questions like, are you employed as what they call a PAYG employee? So you're employed by someone else, or do you own a business? And there'll be different evidence required for that. Do you have bonus or overtime income? Again, something a broker can help you with is every single lender is different in terms of their policy relating to different income types, different property types. It can really, really vary between the lenders. Each one has something called a credit policy where they essentially say, this is the types of loans that we're willing to accept and the types of applicants we're willing to accept. So a broker can help you actually understand which lenders might suit your needs. I guess if you're a normal full-time salaried employee, you're probably what the banks would call a very standard type of applicant. But if you own a business and you've got a lot of kind of non-traditional income, there may be certain lenders that might suit your needs a little bit more than others, for example. Other things that are important are things like, do you have children? Unfortunately, banks know that children are expensive. And then when it comes to expenses, how much do you actually spend in a month? Banks will often have kind of this threshold, kind of this minimum threshold, essentially, that based on current living expenses, generally they'll keep you at, but do you actually spend kind of over and above that? Have you had one-off expenses that you've had to pay, things like that, because they will want to know whether you essentially can pay off the monthly loan repayments. Then we go to assets and liabilities. So this section is all about essentially how much funds do you have available to put down towards the property. So things like savings, other assets you might be able to sell to fund that purchase, other assets that could potentially be used as security. Now, what that means, an example of that would be using equity from another property to put into a secondary property purchase. I am planning to do a session all about using equity and things like that later on, so keep an eye out for that one. And on the liability side, are there any other debts that you have that would limit your ability to get a loan and also pay off a loan? Things like credit cards, personal loans, car loans, HEX debt, all of these things lenders do look at when you're going to apply for a loan. So yeah, again, speaking to a broker can help you understand the impact of that on your what they call borrowing capacity, which is essentially, here's my income, expenses, assets and liabilities. How much do we think the banks are going to allow me to borrow? And what is the impact, for example, if I cancelled a credit card or if I paid off my HEX debt? Those are the kind of scenarios you can start to look at. The third part here is the property itself. So the banks will actually look at the property itself and decide if that's something that they're I guess, willing to accept. So examples of this are, is a property a house, a unit, or land? Is it a new build, or is it an existing property? And is the property in a high-risk area? Now, this is a particular area they do look at. So, for example, some lenders won't lend in certain areas at all. Others will say, for example, yes, you can buy a high-density apartment in a high-density area. Just an area that comes to mind is Zetland in Sydney, for example, lots of high-rise apartments. So that is an area that some lenders will say, we define this as a high-risk area. we'll still lend to you in this area, but instead of offering you an 80% loan on the value of that property, we're only going to offer you a 70% loan, just as an example. That's not defined data, but it's just an example of how they'll say, we're going to limit our risk on this property by actually saying you've got to have a higher deposit in order to fund that. So other things, for example, are rural properties, so kind of big land, farms, things like that. They'll tend to be tighter restrictions around lending on those because they're often harder to sell, for example, and they, have their own fluctuations too. And areas prone to natural disasters as well is always important to have a look at as well. So things like floods, bushfires, earthquakes is not so much one in Australia, but we definitely have some of those other natural disasters. So looking at those areas too. Also important for things like insurance, not something we're covering today, but it is really good to look at the area that you're buying in more broadly. Okay, I hope I'm not going through this too fast. There will be a recording available too, and I'll send that around to everyone after. So if you want to go back and pause it at a certain point and look at a specific slide, you can. Now, government schemes, there are a lot of government schemes out there. These three are not exhaustive by any means, but they are probably the three I see come up with clients the most often. Each of these do have certain eligibility requirements. So there's really clear pages on the government websites in order to find these. But yeah, at a very high level, I'll go through them and then feel free to contact me if you want more information and we can have a call specifically on one of those. But the first one is the First Home Guarantee Scheme. This scheme is essentially helping people with their deposit. So it allows you to borrow up to 95% of a property's value without paying lender's mortgage insurance. And lender's mortgage insurance is essentially something that normally if you want to buy with a less than 20% deposit, the lender, they might say, okay, we'll give you that loan, but we're actually going to charge you something called lender's mortgage insurance to protect ourselves again and limit our risk that way. So they'll essentially pass on that cost. It protects the lender, but it's on you to pay that cost additional. It can vary greatly, obviously, depending on the loan size, but it can be in the tens of thousands of dollars. So it allows you to avoid having to pay that and having a much smaller deposit than you'd normally require with a very standard 80% loan to value ratio or a 20% deposit loan. Eligibility requirements on that one. On any of the first home buyer schemes, they've actually upped a lot of the residence requirements. So it used to be that you had to live in it for 6 months within the first 12 months of owning that property. Now it's that you have to live there for 12 months and you have to move in within 12 months of owning that property. So they have upped that residence requirement. There were cases where people were essentially kind of leaving places empty and pretending they lived there for 6 months just to get the scheme. So the government is trying to protect against that and really making sure that people are using these schemes that actually need it. So I do think that's a good thing. They're upping those residence requirements there. There are income restrictions as well. So you can't have earned over a certain amount. Again, there's a whole page on this that I can send around afterwards, but yeah, there's different requirements. And if you're buying with someone else, neither one of you kind of owned property before as well, just an example. For the first two here, so the First Home Guarantee Scheme and the First Home Buyer Assistance Scheme, there are also property price caps depending on where you live. So as an example, these did actually go up slightly recently, which is nice. But as an example, in Metro New South Wales, Sydney, the property price cap is $900,000 in order to be eligible for that First Home Guarantee Scheme. So yeah, $900,000 is top. It's slightly lower for more regional areas and for other states as well. So make sure that you check for your specific area where you're wanting to buy. The First Home Buyer Assistance Scheme, this one is a stamp duty scheme. So depending on the property value, you'll either pay no stamp duty or discounted stamp duty. I believe, and I always get this mixed up, it's either $800,000 or $850,000 for paying no stamp duty. So if it's below that, it's no stamp duty, and up to $1 million for discounted stamp duty. So if you're buying in the realm of 800 or 850, always mix it up, to $1 million, you get discounted stamp duty. So it's kind of on a sliding scale where if you're closer to the million, you'll pay more and more and more stamp duty up until the $1 million mark, when you've got to pay, unfortunately, full stamp duty. Again, there's eligibility requirements on this one. There is no income eligibility requirement on that one, but there is the residence requirements, obviously the first home buyer requirements in terms of not owning property before, and the property price caps there as well. And then, so these probably are the two most well-known schemes out there. The one on the right, the first home buyer assistance scheme, that is a New South Wales scheme. There are very similar schemes in other states as well. Not all states have it, and they vary slightly in terms of their caps and things like that. So it's always important to go to the specific state if you are in another state other than New South Wales, but that one is a New South Wales scheme. And then the bottom one is something that I find not a lot of people know about, and it's the first home super saver scheme. And I guess this scheme is a little bit trickier in the sense that you kind of got to start using it a couple of years before you're ready to buy, or at least 1 year before you're ready to buy. Essentially, the first home super saver scheme allows you to make additional contributions. And I guess why do not many people look at this? I actually I work for a company as well that does super, and not a lot of people are very engaged with their super. They kind of get their employer contributions in and they don't really think too much else about it. So it's not something that's front of mind, but this scheme actually does allow you to make additional contributions from your before tax income into your super. Again, I won't go into detail on tax. Please Google the first home super saver scheme if you'd like to know more. But it allows you to make before tax contributions to your super, which does have a different tax rate than your income tax. And it essentially allows you to save up for a deposit for your first home. So you can make up to $50,000 of additional contributions over 5 years. There is a yearly cap as well to that. I think it's around $15,000 a year, but double check that on the ATO website. Up to $50,000 over 5 years, that once you're ready to then purchase your first home, you can actually withdraw those funds and use it to go towards your deposit. Now, this one, you're making additional contributions, so it is, I guess, money that you're putting in that you won't otherwise have, so keep that in mind. And the other thing is, if you don't then use it to buy a home, there will be certain tax implications and things like that on those funds. So this one, a little bit more complex, I guess, for most people, but the ATO does a really good job of explaining it. And I will send around links to all of these pages afterwards as well, so you can read a little bit more about them. And then you can contact me if you'd like to have a call and we can discuss them in more detail. Alrighty. I think this is the last question I'm going through, and then I'll do a quick whip of what a broker is and what we do. But owner-occupied versus investment. Getting this question quite a lot, specifically from young people in Sydney who go, oh, I don't know if I'll ever be able to afford a home in Sydney. I want to rent in Bondi, or I want to live in Bondi, but I can't buy a property there. So do I just wait forever and never buy, or do I actually look to invest and I guess give up the ability to use those schemes in future? So if you buy your first property as an investment, you will essentially lose the right to use those schemes in future because you are no longer a first-time property owner. So that is something to keep in mind when you're considering these two. But I've just done a little bit of a kind of benefits of each for you so that we can go through it. So on the owner-occupied side, got at the top there, like I mentioned, it's one of the key eligibility requirements for most government schemes. So you'll give that up if you do choose the investment route. No capital gains tax when you sell. So again, there's a bit of nuance around this, but when you sell a property that you live in, there's essentially no capital gains tax versus an investment property where you do pay capital gains tax when you sell. You don't need to pay rent on another property if you're living in it, obviously, and it's yours to change and live in. So as opposed to a rental where you're quite restricted on what you can do with that property as an owner, you've got a lot more license to do what you will with that property. On the investment property side, there are some tax incentives, obviously, for owning an investment property. You can earn rental income over time. Now, we never can predict the market, but over time, I guess the loan size that you initially have stays the same. And the hope is that that loan actually goes down, and then you've just got that rental income that is hopefully going up over the long term and can help you kind of pay off that loan in the short term, but then keep earning that passive income in the long term as well. Again, there's a whole lot of nuance around that as well, depending on the area. I will do a session more specifically on investment properties where we'll go through a lot of the terms like negative gearing that you might have heard about before, but that's it at a very high level. And as I said, with a lot of people I'm speaking to, it may be more affordable to buy a property in an area you want to live. For example, I've put adored there, it's afford. You might only be able to afford a small apartment in Sydney, but you might actually be able to buy land and a house in Brisbane. And for example, if you did want to do a renovation project and add value to the property, buying somewhere that has a house and has land, you might actually be able to do more to that property than you could in an apartment block, for example, where there can often be a lot of restrictions. My apartment's in a block, for example, where we can't even add air conditioning because it was built in the 1930s. So it's got a lot of restrictions, for example, on what you can do there. So it is a good one to know. Alrighty, before I see if there's any questions, and sorry if there's been stuff in the chat, I just can't see it with all my screens going at the moment. Why would you use a mortgage broker, or what is a mortgage broker for those of you that might not know? I thought it was good, considering I am one, to actually tell you a bit about it. So according to Money Smart, a mortgage broker is a go-between who deals with banks or other lenders to arrange a home loan. Mortgage brokers must act in your best interest when suggesting a loan for you. So that one's actually, I guess, regulation, that mortgage brokers are required by law to actually act in your best interest when suggesting a loan, and they cannot act in their own financial interests or any other interests for that matter.